And we are live. Akhil, thank you very much for joining us. Live at 5.
Live at 5 with lots of headlines and lots of updates. I'm looking forward to it. Thanks for having me.
We do like an update, and we've got some questions to obviously go off shortly. But before we get into it, if anyone that is jumping in, listening live, then give us a like, drop a comment, as today is your chance to put Akhil on the spot, as we mentioned. So no pressure to Akhil.
Yeah, I'm looking forward to it. Bring them on. Bring it on.
And anyone that obviously is listening after this live call today, they can still get involved. So what's the best way for them to send you a direct message, Akhil?
Yeah, I think the best thing is log on to our website, ourmortgagebroker.co.uk. There's a contact us page. We'll call you back when the date and time that you choose. And you can get to know more about our services and the friendly team at OMB.
And obviously, if anyone's listening on the podcast channel, all the details will be in the show notes as well. Or you can reach out to myself or Andy directly. I am without him today due to technical issues, but I've got it under control and I've got the questions in front of me. So we'll get stuck straight into it, Akhil.
Perfect. Let's do it.
So the first one, obviously, following on from the BRRRR strategy that we had, that we released on Friday. This is all related to that. But obviously, if anyone has a generic question with regards to the property market and so forth, then I'm sure we can get them answered as well. But the first question that come in was, can it be applied to commercial properties as well as residential?
Yeah, so let's give a quick context about the BRRRR strategy. So B is standing for buying it. The first R is refurbing it. Then you're going to rent it and you're going to refinance it. So that's the BRRRR strategy. And the last R is probably repeating it, right? So in short, yes, it can be executed for commercial properties as well. Same principles lie. The same process does remain the same. It's just with commercial acquisitions and assets, the exit will need to be sewn up certainly at the forefront, because ideally the only way you're going to get a mortgage on a commercial property is when you've got a long lease signed and delivered. So it's unlike a residential property where even if it's unoccupied, the lender will still lend on it with a view that it will be rented out in the imminent future. Whereas commercial, because of the transition that is going through at the moment, you've just got to be mindful of the terms and conditions that come along with it. But yes, certainly the BRRRR strategy works for residential and commercial.
Perfect. And then the next question that come in was, how much money do I need to start investing using the BRRRR strategy?
Right. So the long and short of it is, the more you can put in on day one, the better terms you're going to receive. And if you're looking for funds to develop the property, because it needs a refurb, obviously in this strategy we'll be needing a refurb, the more you put it on day one, the more flexible the terms are going to be, the arrangements are going to be, and the drawdown facility is going to be. I would say typically, if you're going to get into any BRRRR strategy using a bridging loan and refurbishment costs, I would say the rule of thumb would be at 35% of the purchase price. So go with 35%. If you're slightly short, you're at 25 to 35. There's still a conversation that we can have. And there's other alternatives that we can raise capital using perhaps other properties or other surplus income that you've got in the background. But rule of thumb, 35% ideally. But it's not a deal breaker if you haven't got that. Leave that finance headache to us. We'll hopefully find you a solution.
I think it'll also come down to what work's required in the property, because if it's just an uninhabitable, i.e. no bathroom or whatnot within that kitchen, and it needs like a major refurb throughout, it's obviously going to cost more money. But if it's all minor stuff, then that will obviously have an impact on that. So, and on where you're obviously looking to invest. Yeah,
and just to add, there's a couple of other lenders out there in the market that don't actually stipulate that you need to go on to a bridging loan and then a buy-to-let. There's a couple of lenders now offer products where they can provide you with a buy-to-let and you can do the refurb on day one. And then once the property is ready, then you can occupy it. It actually saves on costs, but there's some terms and conditions that are tagged alongside that. But yeah, get in touch. We'll hopefully be able to sort that out for you guys.
Perfect. And the next question that come along, Akhil, was, how do I identify the right property to invest using this strategy?
Okay, so first things first, the estate agent is going to be your best friend. Yeah, so you need to get in touch with all your local estate agents, the areas that you're looking to invest. And when you're speaking to the estate agents, be very specific. Sorry, after 5. Specific. That's the one, buddy. Be very specific on the location, the type of property, the works that need to be done. So tell them you're looking for a buy and do uppers, right? You want to do it up to refinance, take some cash out. So explain to the agent what your game plan is. Tell them the type of property that you want to buy, the purchase price that you're looking to buy it for, and on particular streets. So just bear in mind, some streets carry an extra weight in terms of costs because they're better located for whatever reason. So be very specific on those variables. So the first one is get in touch with the agents. Second thing is, before you speak to anybody, you need to speak to a finance broker like ourselves. And we're then going to talk you through the costs of obtaining the funding, what the terms look like, what the repayment strategy looks like, in a ballpark figure. So they're fundamentally your two go-to people. In terms of the location, I'm a big fan of always investing in the areas that you live and work, because you know those areas very well. I understand in certain parts of the country, you don't want to invest there because the cost to acquire the property is quite high. So you might want to look further than not Watford and beyond. So there's lots of conversations that can be had. But again, the other thing is self-education as well, understanding what parts of the country are thriving, where's the undervalue, where's the regeneration coming through. And then that's, again, having conversations with local agents, local property sources that can understand where the trends are coming. And I always say, don't follow the herd. Understand actually what regeneration is happening in the next 2, 5 or 10 years time, and get in there early. Because if you follow the herd, you've already missed that boat, to be honest, and you're going to be paying top dollar rather than below market value deals.
I think it is also important to note that if you're investing in an area, you have a basic or should have a basic understanding of what you're looking to purchase. Whereas if you're going out of area and speak to someone from that area, remember that agent is there to sell properties. And of course, it's going to be the best town. It's going to be the best place to invest. So at least do some research yourself and don't just go by that one opinion. Do your research and make sure that it is the right investment and it is going to see the return that you want.
And also, look, when you go and visit these properties, visit them day and night and on weekends and weekdays. Don't just go on one viewing, put an offer in and complete. Understand the dynamics, what works in the area, what type, how long the tenancies are for, what the void periods look like in between. And also, if you're investing outside where you live and work, obviously understand who the property professionals are going to be in that area. So if you're investing in London and you live in Bracknell, for example, you need to understand who the builder contractor is going to be. Look at their experiences and visit sites that they've done refurbishments on. So then you can use them as a CV and as a guide. So, that's another big factor, that having the right people to work on your properties.
Perfect. And you mentioned about void periods and rents and tenancy lengths and so forth. A lot of this data I can get for anywhere within the country. So if there is a specific location that you want this information, feel free to send me a DM, and happy to help with that and send through the report to you. We've just had a question come in live from Ian Macbeth saying, "Hi Akhil, great convo. Is buying a property at auction very different from the mortgage lender's perspective, or is it just buying just like buying normally?"
Yeah, so you can think of it as an auction like you're buying it from an estate agent. The only tagline with an auction means it's you put your deposit down, you exchange contracts on the day of the bid. So if you win the bid, you exchange immediately with usually a 10% deposit. The next factor that goes alongside that is you've got a ticking time bomb, in terms of you've got usually 56 or 28 days to complete. So you've got you're contractually bound to that agreement, and you've got to complete within that time frame. So before you put in any bids at auction, first of all, you need to do your due diligence on the property itself. There's usually a legal pack that you can read ahead of the auction. Read the legal pack, get your legal pack reviewed by a conveyancing solicitor that understands reviewing of legal packs and understand what the pros and cons look like with the legal pack. Is there any inspections that you should pay for ahead of the auction? It will obviously be at your cost, but spending money on surveys can cost you, a small fee can cost you, save you a lot of money in the future, I should say. The other thing is have your finances ready to go. So if you're buying from an auction, as I said, it's a ticking time bomb, 60 days to complete. Usually you can't get a mortgage within 60 days. It's pretty difficult, bearing in mind mortgage lenders, SLAs at the moment, and then the conveyancing searches as well. So it's usually in cash or via a bridging loan or auction finance, which we can certainly help with that for our clients as well. But yeah, the process is very, very similar, but just think of auction finance is it's a home run, because you've exchanged, it's your property in that certain period of time. Whereas if you buy a property traditionally through an agent, you could have chain breaks, you could have various reasons why it falls through. Whereas an auction is virtually set deal, it's a done deal really. You just need money and complete on that time frame.
I'm glad you mentioned bridging. So anyone that's tuned in later or watching this video at a later stage, we do have a podcast coming out where we go into the specifics of bridging, the costs, and that is also with Akhil. So that will be coming live in the next couple of weeks. If you keep an eye on our pages, you'll see more information of that. And obviously any questions with that side of things, then feel free to send through a question, and we'll get them answered for you. But bring me on to the last question, Akhil. It's come in to our Facebook page, which is, what are the risks involved?
So what are the risks? So with the BRRRR strategy, everything's a risk, but it's how you calculate them, and you preempt any risks. So if you're buying something from an auction, read the legal pack. If you're entering into a bridging loan agreement with a lender, understand how you're going to repay that bridging loan, because bridging loans are a fantastic resource, but you're paying a premium for that type of resource. It's usually a quick in and out strategy for you then to enhance the value and then refinance onto a typical buy-to-let mortgage. So there are certainly risks. I think the biggest risks are not having a plan A, B, and C for the exit of that bridging loan. The other risk I would say is, if you're looking to do a heavy refurb on a property, until you knock the floor, knock a wall down or remove some flooring, you don't know what's behind that wall or that floor panel. So you're just going to be conscious of, you might think it's going to cost you £50,000 to do a refurb, but when you dig a bit deeper and knock a couple of things over, you might realize that that 50 now is now gone to 65,000. So ensuring that you've got some extra little buffer in your bank account to cover any of those things that could occur. Basically, the rule of thumb is usually 10%. So if the refurb's costing you 50, you should have an extra 5,000. I'm a bit more cautious, so I always say 20%. It's better to have more than less. So I'd certainly say 20% over your exact refurb costs. Again, the refurb costs are probably going to be outlined by your building contractor. Again, compare apples and apples. Go out to tender with 3 or 4 building contractors, and then you compare apples and pears together that way.
Do you find that you get many trades that get involved with the BRRRR strategy, because obviously they can do it at a lot cheaper price, the labour? Yeah. Did you typically find that quite often?
Yeah, you know what? That is fantastic. So someone that, also known as joint venturing, right? So I think what you're alluding to, Tristan, here is I've got no money to put into a deal. You've got the money and you've got the time, whereas I might be a builder, right? So I've got no cash to put into a deal, but I'm the builder, hands-on, but you've got the cash and you've got no time. So we can do a JV there. So what happens there is I've got the skills with the tools. You're the guy with the cash. You're going to put money into this deal. What happens here is we're splitting the risk. Everyone's not putting in all the money all in day one. For example, I might be able to put in 5%. Tristan puts in the other 95, for example. So it's a very handy tool for those that are looking to scale in their property portfolio, I should say. And the other thing is, when you've got a builder contractor on board with you, they've also got reason to make sure that the refurb is done on time and at the right price. So I always say is, if you're entering a BRRRR strategy, work with perhaps a builder contractor on the next venture, because they've got skin in the game, whether it's own capital or they're going to deploy their workforce onto a project and get the best results for them then to make a profit on. You might do a profit share on the back end, or they might become a life partner in your property journey. So I certainly think it's like anything, if you want to go far in life, you go together, right? I think there's a saying. But again, JVing with the right people with money or more time than you, or more experiences, or on the tools, they're a great resource, great person or persons to do JVing with.
So just had another comment come in from Stuart.
Yeah.
So thanks, Stuart. Ian Macbeth, great question. Got a friend buying an auction this week. Would be good to know if he could split and buy 2 with mortgages.
Actually speaking, would be good to know if he could split and buy 2 with mortgages. I don't know what he means by that, but again, the key here is with auctions, you're against time here. I can't guarantee that mortgage. No mortgage broker can guarantee it ahead in that time frame. So it might be a case of buying it in cash or buying it via an auction finance rule, and then we can then exit onto a mortgage thereafter. Again, if we apply for a bridging loan on a Monday, you've put the 10% down, you've exchanged. We apply for the bridging loan immediately, and then we can also apply for the mortgage immediately as well. Especially if there is no refurb works to be done. If it is mortgageable and habitable, we can start the application and get the valuation booked. And most bridging lenders only have a 1-month tie-in, so you only pay interest for 1 month, which is amazing. So it's certainly doable. But yeah, if that person can, I think Stuart, get in touch with me and I'll be able to give you the exact confirmation to your question. Because I'm a bit.
Well, if you're still watching, Stuart, send the comment over in a bit more detail so Akhil can get a better understanding and answer that for you live here now. Just before we go, or hopefully that will come in, Akhil. And one question from myself actually was doing buy set of the week the other day and come across a 3-bedroom property in Semalong, Northampton. It looked great value for money. Off the top of my head, I think it was about 185, which is low market value for what it should be for a 3-bed. However, in the bottom of the description, it mentioned about Japanese knotweeds, which would obviously reflect the price on that. Now, I know in the podcast you mentioned there aren't so many restrictions with the lending criteria because it's a different category. But is there anything in that instance? Because I know from a mortgage it can be a bit of a headache having Japanese knotweed. But is there anything from a BRRRR strategy point of view?
Yeah. So if you've got the investment hat on and you're looking to go down the BRRRR strategy, anything quirky, anything dirty, anything damp, anything with Japanese knotweed should be of interest to you, because usually the average buy-to-let investor wants something nice and shiny, ready to go, which is nothing wrong with it, but there's no real value add. Whereas if you're buying a property that is distressed, tired, not mortgageable, not habitable, it's got a bit of Japanese knotweed in the back or the front or the side, you know, there's a viable angle for you to go in, clear the situation, make it all good, and then applying for the mortgage. And that's where the uplift is on the value of the property. I always say to our clients and our investors, the best time to make money in property is on your purchase price, day one of the acquisition. So, you know, I always say trying to find the cheapest property on the street, or if you can't, find the one that is so dated that needs a lot of work that people have just shied off because they haven't got the time or patience or even the equity to do the investment. So Japanese knotweed is not a problem. It's very very common, but it does come up quite often. There is lots of treatment programs. There's lots of insurers that will back it. Even if it has got Japanese knotweed, if it's been treated or not treated, get in touch with us. If it's 1 meter away from the door or 20 meters away from your back door, side door, front door, still get in touch with us. There's always solutions for most inquiries, I always say.
Perfect. Well, thank you everyone that's got involved with the questions this week. We will have another podcast on Friday being released, followed with another Q&A. But as I mentioned at the start, if anyone has any questions that are unanswered for myself, Andy, or Akhil, get involved. All the details will be in the show notes or our social platforms, which ours is obviously at Andy and Tristan, and Akhil is our mortgage broker, or on their website. But thank you very much for your time, Akhil. I really appreciate it.
Pleasure. Can I just leave one thing with you guys and your viewers out there? There's a couple of things that we haven't touched on, but let's perhaps do it on another video. One is the return on investment calculator. I'd love to share this with your viewers. And the other one is the rental yield calculator. And fundamentally, these are the two calculations that everyone must be using when they're looking for buy-to-let properties out there. So we'll touch on it on another video, but rental yield calculator and the return on investment calculator. Let's talk percentages perhaps on the next video.
Yeah, we'll definitely do that. And that can go out across the pages with more information.
Sounds good. Thanks again. Appreciate your time.
Thanks for your time.
All the best.